weekend. Ira Epstein with your weekend edition of this agriculture update for Friday, the 21st of June, 2019. As we're getting on towards 3:30 p.m. Central Daylight Time, you can see the stock market's finishing off the week on a down day, but it's been a very important week to the upside. As you take a look at what's been going on here in the grains, today was a down day, and not a surprise. The market has seen nothing but rain and bad weather, so now the market's looking ahead, hoping to get a forecast that's a bit less rain. The question is, how much in the way of soybean acreage can we get done before the end of June? Corn is done in terms of planting. Anything now is not being planted. Wheat's just a follow-through market with it. Now, we did have today the cattle on feed report, and here's the recap as I see it. The June cattle on feed was 102%. The estimate was 101. The prior month, 102. But this is the most amount of cattle in history on the inventory for the month of June since record keeping began in 1996 of this. The placements were a bit higher at 97%. The prior month was way higher than that, though, at 109. And the marketing's about where they were. The estimate was 101, and that's where you're at. So is this a bullish report? Certainly not. You have more cattle is what you've got. Now the question is, where does price find demand for it? That's one of the ways to look at this. The big bull market, of course, and what everybody's talking about are soybeans and corn. Are we going to get corn over $5 and maybe to $6? I promise you that is the talk that I see in a number of letters I respect and traders I'm talking to. But you go through phases in a bull market. The typical phase is bad weather, the crops get in, and you get your normal whatever you're going to get. This is the different year, and you don't get these very often. So now you're at the point where the crops for the corn has gotten in. The beans are yet to get all the way in. Cotton's in, not looking bad. But the question is, what about beans? Well, it's going to become a game of projected acreage lost and yield as to what it's going to be. So it's going to become a math game very soon. You're not there yet. That starts July 1st, in my opinion, because there's going to be a certain amount of acreage that their farmers are just going to walk away from. It's too wet. But as we look at it, the market's not been able yet on a monthly chart to get up to the 18-month moving average of closes. When we come to a daily chart, you can see how you've spiked from the 780 level on a weekly basis, and that's what we do in these charts. We start off with a monthly chart, and then all the other charts are going to be weekend charts on our weekend edition of this update, and that's because we're looking at the bigger picture. And as I see the picture, and what I've been pointing out daily, is we're in a resistance area. You can see the old area right here. If you punch through this and get through the 940 zone on a closing basis, you set up the potential to go back up to the 1020 level that we were at way back at this time frame at the end of 2018, beginning of that year. So the market fell rather hard, about $2.50 a bushel, and now instead of worrying about China, you have to find a price where the farmers are willing to give up last year's crops and let things go. That's the game that you're in right now. In terms of swing line, you have a pattern of higher lows and higher highs. That's bullish until you take out this last break low at 848 and a quarter. In terms of resistance and support, two areas that I'm looking at now are the 18-week moving average of closes, which is under the market at 873 and 3/4, and resistance at 928, the 100-week moving average of closes. I always put on the Bollinger Bands as well to see where they're coming in, and they're starting to fit in with this 928 and 3/4 area, offering the resistance there. If you were to take out, as we said, this 848 and a quarter, well, then you could be going down to support at 807, but you'd have to give me a big reason why that's going to happen. I see more risk to the upside than I do to the downside, because if trade talks with China should get back on track at the G20, and should the track be a real one rather than the two presidents of China and the U.S. getting together, yes, we like each other, we're going to get our negotiators to talk, but we're back where we were 6 months ago, nothing good is going to come of that. Robert Lighthizer has been interviewing American companies. He's in his 5th day of 7 days of interviews to get their feed on the tariffs. He gives that to the president before the president goes away for the G20 meeting, and that means the president has all the ammunition to either hold back, as he did with Iran apparently and didn't retaliate, and give the negotiators a chance, or to say, no, we're not making any headway and here's the tariffs. Either way it goes, he's done what he had to under law with that waiting period and now the interviews. So the resistance in the market up here at 928 3/4, support back 873 3/4. On the slow stochastic momentum, it's still pointing up. And remember, on weekly charts, I don't look for overbought or oversold. I look purely in the direction of momentum, and it is up. In the meal market, we hit a key resistance area. You went to the 100-day average, and you had done this, if you look back here, about 4 weeks ago, and from there the market got thrown back, and this week it's come back up to challenge that number. In the process, you've set up the pattern of higher lows, you've had higher highs, and you are respecting, at least momentarily, this number. And if we look at the week in the meal market, I know that most people wouldn't realize it, but you're down $8. You're not up for the week. And when you go to soybeans, you were up 6 cents for the week. It feels like so much more because of all the stress that we've all been in these markets. In the soybean oil, it's actually gained on the meal. If you look on a weekly basis, it's up 80 points where the meal market is down. You've got the pattern of higher lows, higher highs, and it did manage to squeak out on the weekly chart a close at 28.44 over the 18-week average. So I have momentum up, I have bias up, I have trend up. If the market can get traction, maybe you can get up to this 100-week average of 30.46 and 30.56, the upper Bollinger Band. If it starts faltering here, you got to be careful that you don't take out last week's low, because that would throw the market back into the sideways action. The one thing you can expect is a lot of choppiness now. In the corn market, we finished out the week at 442 1/4, right back under the upper Bollinger Band. So you had your run, got over the Bollinger Band, as you can see, extenuated on bad weather, fell back under it on the week of the 17th, back up and over the upper Bollinger Band, and now back down. And for the week, we lost 10 3/4 cents in the beans. You wouldn't think that if you read the news headlines and so on, but that is what's been going on. So this market, I'm not saying it's peaked, I'm saying the market's got to go through a condition now where we start judging yield and how the corn is doing. There'll be a term you hear, knee-high 4th of July. Is the corn that is planted, how high? Is it going to be shoulder high, knee-high? Where's it going to be? But I'm not just asking for those few fields that are going to be great. I want to see fields in Illinois and Indiana. How are they doing? Because they have been waterlogged. In the wheat market, the resistance is shown at the upper Bollinger Band. It began doing that 3 weeks ago when we got here. We're able to extend up a little bit last week and lost 12 cents back and under that number this week. Support back right through here at 477.5 to 469. But remember, you've had a market that's pulled itself along straight from this zone, the 416 level, all the way up to this week's high of 549 without a lower week in between. Do you see that? This market might need a bit of a consolidation, to say the least. In the cocoa market, the trend is up, higher lows, higher highs. You hit the upper Bollinger Band, you back off. You go back to it, you're backing off. Momentum still locked in, bias locked in. Resistance 25.67, support back in the neighborhood of 23.50. In the sugar market, the chart has run into serious resistance where it did before at the 100-week average of closes. The seasonals are still up through the end of June, but the market on the daily chart and the weekly chart is starting to show some weakness. The pattern is one of a lower low and a higher high. To get the next phase to the upside, you probably have to close over this 100-week average, let's say over the 1278 level, and that would put the possibility of wherever that upper Bollinger Band is next week, that would be your next resistance point. The overall pattern has been a sloppy sideways pattern in the market. In the coffee market, we've had a pattern of higher lows in place. This week we fell back down, got support at what I call that line in the sand, that 18-week average of closes that so often shows up at key on pullbacks as support and on the way up as resistance. You hit the upper Bollinger Band. The theory of the Bollinger Band, if you don't remember it, is the market will trade within those black bands 95% of the time. That doesn't mean you can't trend like you were here, but you will stay within the bands is the point. So as the market gets to the top band or to the bottom band, you often see trend traders take some of their, whatever they think that trend was, to get to the lower band. They think it's in a downtrend, to the upper trend, to the upper band, an uptrend. Now you got back to neutral territory, but you're still in an uptrend unless this week's low is taken out, and the market did gain nearly 400 points for the week. In the cotton market, it looks bearish to me. It's still lower highs, lower lows. You see how the 100-week average, in the past, you do a little slip sliding, but it's been offering a good resistance point. You're still coming down. The crops look like they're getting the moisture they need, the sun they need in those areas. It's different in the corn and soybean belt. In the cattle market, you can see this market has literally fallen out of bed from the 130 level down to the 106 level. And remember, higher grain costs are facing this market. The good news is, for a lot of cattle that aren't in feedlots, they're grazing out on the lands if they can get away with the mud. And that's, if you will, holding back weight gain to a degree, because you don't want to feed them these corn prices if you can avoid it. In the hog market, for everybody that's been betting that China's buying hogs, they haven't bought the hogs. You're in a downtrend with lower highs, lower lows, momentum is pointing down, and the market finally closed over, if you're a purist as a chartist, 76.25 is well under the 18-week average of 77.57.5. I see this market is still very much in the bear camp. You know, one of the things I try to do with you is offer in the mornings ideas, be it in the grain markets, the meat markets, soft commodities. I get up at about 5 in the morning. I read like crazy. I'm watching. I can tell you what's going on in Asia, then in Europe, and I look at the major reports due out for the day. I start you off by recording at approximately 6:15 in the morning. I start a recording, and it takes me maybe 10 minutes or so to get it done. The charts will look like this. They will look different than the ones you see here. They will have more studies on them. They're going to have a few more moving averages. I'm able to cover the markets, and I do it in a certain sequence all the time so that if you wanted to pull your player on the bottom, it'll tell you right where you're at. But here's the real difference. I'm able to say, buy here, sell there, do this. Here's an idea, be it an options. Here's an ETF idea, because I cover 5 ETFs as well. And I go through all this action for you. And yes, the idea here is that you come in like this. You're scratching your chin. You want to make a trade on the day. What am I seeing? If you respect me and you're watching these videos, it's worth taking a 26.5 cent a day gamble for 30 days to see if you like what I'm doing. It may not be for you. I don't say I'm for everybody. But if you're looking for mentoring or an idea, a reason to pull the trigger, am I seeing something different than you are? That's the way to look at it. Go to our website at www.iraepstein.com. Go under either education or research, morning subscriber video. It tells you all about it, and should you want to try it, that is where you sign up. There is no contract. You can either buy it for the 30-day period, you can buy a 1 year, $156 for the whole year, or you can go every 30 days after the $7.95 at $15 per 30 days. You can also click up here if you're asking. It'll take you right where you have to go. I'm Ira Epstein. You have a great day, and I will talk to you all come Monday. Have a good weekend.